If you're retired or planning to retire in the next 10 years, there's a risk hiding inside millions of retirement accounts, and most investors don't even realize it's there. Just 2 years ago, artificial intelligence was a promising technology story. Today, it's one of the most important investment themes in the world. A handful of companies have added trillions of dollars in value, technology stocks have surged, market indexes have climbed, and retirement accounts have made a lot of money. But there's one problem. When a small number of companies become responsible for a large share of the market, the entire market becomes vulnerable because if the AI boom slows down, even temporarily, retirement portfolios could feel a large impact. Let me explain how we got here. The AI gold rush. For most of the last decade, investors were focused on smartphones, cloud computing, e-commerce, and social media. Then everything changed. In late 2022, artificial intelligence suddenly became real to the public. People weren't just hearing about AI anymore. They were using it, writing with it, searching with it, creating images with it, writing code with it, and investors immediately saw something enormous. For the first time since the internet revolution, a new technology appeared capable of transforming nearly every industry. Wall Street began asking a simple question: what if AI becomes as important as electricity or the internet? And that's when the money started flowing. Hundreds of billions of dollars were committed to data centers, AI chips, cloud infrastructure, and energy infrastructure. The market wasn't just investing in today's profits, it was investing in a vision of the future. And that's where things become dangerous, because markets often move from optimism to excitement to euphoria. The Magnificent Seven problem. Most retirement investors believe they're diversified, and technically they are. They may own index funds, ETFs, or have pension funds. The problem is what those funds actually own. Over time, the largest companies become larger parts of the index. When a company grows from $1 trillion to $3 trillion, its influence increases dramatically. Today, a relatively small group of technology companies has an enormous impact on market performance. This creates something called concentration risk. Imagine owning 500 companies. Sounds diversified, but what if 30% of your portfolio's performance is heavily influenced by only a handful of stocks? That's a very different situation. Many investors don't realize they're making a large bet on technology, and they're making it accidentally. Why bubbles are so dangerous. The word bubble creates strong reactions. People hear the word and assume fraud, scam, worthless, but history tells a different story. Many bubbles begin with something real. The railroad boom was real, the automobile revolution was real, the internet revolution was real, the housing market was real, the technology wasn't fake, the excitement wasn't fake. The problem was expectations. Investors became convinced that growth would continue forever, and when enough people believe that, prices can become disconnected from reality. One of the most dangerous phrases in investing is, "This time is different," because every bubble believes it is different. Every bubble believes old rules no longer apply, and eventually, reality returns. The dot-com lesson. The comparison many investors are making today is the dot-com era. Let's be clear, AI is not identical to the internet boom, but there are similarities. In the late 1990s, investors understood something important. The internet was going to change the world. They were right. The internet transformed communication, commerce, entertainment, and finance. The problem wasn't the technology. The problem was the prices investors paid. Companies with little revenue achieved enormous valuations. Investors became convinced that growth would solve everything. Eventually, the market corrected. Many companies disappeared. Investors lost fortunes, yet the internet still won. That's the lesson. A technology can change the world, while investors lose money. Those two things can happen at the same time. What retirees often miss. Retirees often focus on income. That's understandable. They're thinking about dividends, pension payments, withdrawal rates. What many overlook is portfolio concentration. A retiree might say, "I don't own Nvidia," and technically that may be true, but they might own S&P 500 ETFs. Growth funds, balanced funds, which do own Nvidia. The same applies to Microsoft, Alphabet, Amazon, Meta. Technology exposure often exists indirectly, and indirect risk is still risk. What if AI keeps winning? This is important. We are not arguing that AI will fail. In fact, AI may continue growing for decades. AI could improve healthcare, transportation, manufacturing, education, and finance. The goal of this video isn't to predict a collapse. The goal is to recognize uncertainty, because investors who prepare for multiple outcomes tend to survive longer than investors who bet on only one. The psychology of euphoria. Every major investment cycle follows a similar pattern. First comes skepticism, then optimism, then excitement, then euphoria. At some point, people stop asking what could go wrong and begin asking how much higher can it go. That's when risk becomes most dangerous, because confidence feels safest right before volatility returns. History has repeated this lesson many times. The names change, the technology changes, human behavior does not. What a 20% decline really looks like. Numbers on a screen can feel abstract. Now, let's make them real. A portfolio worth $250,000 loses 20%. That's $50,000. A portfolio worth $500,000 loses 20%. That's $100,000. A portfolio worth $1 million loses 20%. That's $200,000. Now imagine you're retired or planning to retire next year. Those losses feel very different. That's why risk management matters, not because we know a correction is coming, but because we don't. What could cause the AI boom to slow down? The first possibility is simple: expectations. Investors today expect extraordinary growth from artificial intelligence, and when expectations become extremely high, disappointment becomes easier, not because companies fail, but because reality struggles to keep up with the hype. The second risk is economic slowdown. If businesses reduce spending, technology budgets may shrink, and that could affect AI investments. Third, interest rates. Higher rates tend to put pressure on growth stocks, especially companies whose biggest profits may still be years away. And finally, competition. Today's winners aren't guaranteed to remain tomorrow's winners. History has taught us that lesson again, and again, and again. Now here's the important part. What should investors actually do? Let's walk through 10 practical strategies. Number 10. Understand your exposure before making any changes. Understand what you own. Many investors are surprised when they discover how much technology exposure exists inside their retirement accounts. Review your ETFs. Review your mutual funds. Review your pension allocations. Knowledge comes first, because you can't manage a risk you don't understand. Number 9. Diversify beyond technology. Technology deserves a place in most portfolios, but it shouldn't become the entire story. Healthcare, utilities, consumer staples, industrials, energy. Different sectors respond differently to economic conditions, and diversification remains one of the simplest forms of protection available. Number 8. Maintain some cash. Cash isn't exciting. Nobody brags about holding cash. But cash creates options, and options become valuable during volatility, because when markets decline, investors with cash often have flexibility, while investors without cash may be forced into difficult decisions. Number 7. Focus on quality. Not all companies are equal. Look for businesses with strong balance sheets, consistent profits, durable competitive advantages. Quality matters, especially during uncertainty. Number 6. Review your risk tolerance. A portfolio that felt comfortable during a bull market may feel very different during a correction. Ask yourself, could I tolerate a 20% decline? A 30% decline? Your answer matters. Number 5. Avoid emotional decisions. Fear destroys wealth. Many investors sell near bottoms, then buy back near tops. Create a plan before volatility arrives. Number 4. Rebalance regularly. When one sector dramatically outperforms, portfolios become unbalanced. Periodic rebalancing can reduce concentration risk. Number 3. Focus on income. Retirees often benefit from focusing on income-producing assets. Dividends won't eliminate risk, but they can provide stability in cash flow. Number 2. Think long-term. Every major market cycle feels unique. Every correction feels permanent. History suggests otherwise. Investing is often a decades-long process. Keep perspective. Number 1. Don't confuse AI with investing success. This is the most important point. AI may transform the world. It may become one of the most important technologies ever created, but that doesn't automatically mean every AI investment will succeed. Technology revolutions create winners. They also create losers. Investors should remain disciplined. Artificial intelligence could reshape the economy over the coming decades, but retirement investing isn't about predicting the future perfectly. It's about managing risk while pursuing opportunity. The investors who succeed are often the ones who remain diversified, patient, and disciplined. If you found this analysis helpful, don't forget to subscribe to Retirement Unlocked for more retirement news, market insights, and strategies designed to help you navigate an increasingly complex financial world.